history of reverse mortgages. Where did reverse mortgages come from? A reverse mortgage first appeared in Great Britain around the 1930s and soon spread to other parts of Europe in the decades to follow. After its success in Britain and Europe, reverse mortgages finally crossed the Atlantic and arrived in the United States. In 1961, the first reverse mortgage was granted to Portland, Maine resident Nellie Young, a recent widow struggling to make ends meet. She was graced by the generosity of Mr. Nelson Haynes, an employee of Deering Savings and Loan, who created this loan specifically for her. Initially a simple act of kindness, this type of financing revolutionized the mortgage industry by allowing homeowners to remain comfortable in their home through the utilization of available equity. It was more than 15 years later, in 1977, when Broadview Savings and Loan in Independence, Ohio, formally introduced the first reverse mortgage program called Equipay. In the early 1980s, the U.S. Senate Special Committee on Aging issued a report stating the need for a standardized reverse mortgage program. Other committees throughout the mid-80s cited the need for FHA insurance and also uniform lending practices. In late 1987, Congress passed the FHA insurance bill that would insure reverse mortgages, and on February 5, 1988, President Ronald Reagan signed the FHA reverse mortgage bill into law. In 1989, the first FHA-insured reverse mortgage was made to Marjorie Mason of Fairway, Kansas, by the James B. Nutter Company. The 1980s were also when reverse mortgage programs were first mentioned in national media, in Time and Newsweek magazines, and on Good Morning America. Plus, AARP also contributed to the reverse mortgage education enhancement through the creation of an online informational source and a printable reverse mortgage guide for consumers. Since 1989, reverse mortgages have grown in popularity as a safe, government-insured program, allowing seniors to access a portion of their home equity while never having to make a monthly payment. Good day, everyone. Welcome to the show, and I am your host and reverse mortgage specialist, Dorsey G. Tague III. It's difficult out in the world today. Due to the economic conditions that we are all dealing with, it becomes so difficult to make ends meet financially month to month. And for some seniors, it is a struggle just to survive. There are seniors that are either behind on their monthly mortgage payments or cannot pay their property charges, or even after paying all the bills each month, there is no money left over to live properly. Well, imagine having the income one needs to remain living comfortably in their home, utilizing a well-balanced retirement plan, and at the same time make much-needed repairs or renovations to their precious home, or pay off an existing mortgage, or just have the peace of mind of being able to pay their property taxes each year. Reverse mortgages have helped well over 200,000 senior Americans across the country achieve greater financial security, and I hope this show helps you understand how a reverse mortgage can possibly help improve a senior's quality of life. So fasten your seatbelts. Here we go. Today, you are going to be educated on reverse mortgages, which are regulated and insured by the United States government and have been available for seniors for well over 20 years. This is nothing new. Reverse mortgages were designed only for seniors, and it is a financial option that all seniors should be fully educated on. Let's give you a simple definition on what a reverse mortgage is. A reverse mortgage is a special type of home loan that lets a senior homeowner convert a portion of their equity in his or her home into cash. A senior citizen who is 62 years of age or older is eligible for a certain percentage of money out of the value of their home, and whatever monies they take, they do not have to make any monthly payments at all. That's right, you heard it. No monthly payments at all. The loan, being the principal plus interest, is not due until either the senior passes away or sells their home. It's that simple. And listen to this. For seniors that do have an existing mortgage, well, now they have a choice on how they can pay their mortgage off. And I'm sure you're all asking yourselves, what do you mean a senior can have a choice on paying off their mortgage? Well, here are the two choices. Choice number one is basically what a senior with a regular mortgage is doing right now. They can continue to make monthly mortgage payments to the bank that holds the mortgage, and that bank is dictating to the senior the rules on how they want to receive their monthly mortgage payment. The bank wants a certain amount of monies each month due on a certain day. Let's go to choice number two. Based upon what you are eligible for, you can possibly get a reverse mortgage. If approved, the reverse mortgage bank will pay off the senior's existing mortgage, their history. Done. And with the reverse mortgage bank, they will state to the senior that they do not have to make any payments at all and that the loan is not due until either the senior passes away, moves out, or sells their home. Many seniors consider a reverse mortgage mainly because of this simple fact. Even though a senior does not have to make any monthly payments towards their reverse mortgage, if they wish to make a payment at any time for any dollar amount into their reverse mortgage, they can. There is no prepayment penalty. So if a senior wants to make a mortgage payment of $600 in the month of August and then $500 in December, go for it. Do they have to? No. Can they? Yes. With a reverse mortgage, a senior can dictate their own rules on paying back their loan.
Frequently asked question number 1. What exactly is a reverse mortgage?
A reverse mortgage is a special type of home loan that lets a homeowner convert a portion of the equity in his or her home into cash. The equity built up over years of home mortgage payments can now be paid to the senior. But unlike a traditional home equity loan or second mortgage, no repayments are required until the borrower either sells the home, passes away, or no longer uses the property as their primary residence.
Frequently asked question number 2. What are the advantages of a reverse mortgage?
And the answer is, there are many, and here are a few of the most significant advantages. Advantage number 1, remain independent. Stay in their home. A reverse mortgage allows a senior to remain in their home and retain home ownership. Advantage number 2, no monthly mortgage payments. A senior does not need to pay back the reverse mortgage loan nor make any monthly mortgage payments until they permanently move out of the home. Advantage number 3, tax-free money. And the reason is, the monies a senior receives from a reverse mortgage is not considered income because it is a loan. If the government taxed all loan proceeds, nobody would be taking out loans. So to recap, the monies a senior receives in a reverse mortgage is tax-free income and will not affect a senior's Social Security or Medicare benefits. It might be advantageous to consult a tax advisor also. And advantage number 4, freedom and flexibility. The money a senior gets from a reverse mortgage is theirs to use in any way that they choose. Okay, moving along. Let's talk about the qualifications for getting a reverse mortgage. The qualifications are as follows. Qualification number 1, a senior must be at least 62 years old or older. Qualification number 2, the senior must be the owner and on title of the property. Qualification number 3, the home that the senior is utilizing for a reverse mortgage must be their primary residence. And qualification number 4, the monies a senior is eligible for must pay off any existing liens or mortgages. As I stated before, a senior is eligible for a certain percentage of monies based upon 3 factors mainly. Number 1, the value of their home or the FHA lending limit, whichever is lower. Number 2, the age of the youngest borrower. And number 3, the current interest rate. And let me give you an example. We have a husband and a wife that wish to get a reverse mortgage. The husband is 68 years old and the wife is 62 years old. The monies that the husband and wife will be eligible for will be based upon the youngest borrower, which in this case would be the wife's age. And for further understanding, let me show you by viewing the chart. Here we have 2 homes side by side. They are both worth $300,000. We have a 62-year-old senior living in House A, and we have an 82-year-old senior living in House B. The 62-year-old senior would be eligible for roughly a net figure of $140,000 out of the $300,000 home value. The 82-year-old, having the same identical house value, would be eligible for roughly a net figure of $170,000 out of the $300,000 home value, a $30,000 difference. The older a senior is, the more monies a senior would be eligible for. Let's go back to the qualification chart and view qualification number 4. The monies a senior is eligible for must pay off any existing liens or mortgages. Let's put this statement into perspective. Let's go to the chart. In generality, let's say a senior is eligible for $200,000 in a reverse mortgage based upon their age and house value, and the senior has an existing mortgage of $150,000. In this example, the reverse mortgage bank will take $150,000 out of the $200,000 the senior is eligible for and pay off the existing mortgage. The senior does not have to make any more monthly payments. Plus, the reverse mortgage bank will mail a check to the senior for any additional funds they may be eligible for. Let's say a senior is eligible for $200,000 in a reverse mortgage based upon their age and house value, and the senior has an existing mortgage of $210,000. In this example, the senior is eligible for only $200,000 in a reverse mortgage, but has an existing mortgage of $210,000. Well, either the senior comes up with the difference of monies out of their own pocket, which in this example is $10,000, or the senior cannot get a reverse mortgage. And on a side note, the $10,000 difference cannot be borrowed funds. Monies must be from either a senior's checking, savings, or investment accounts. Having a longtime friend or family member gift a senior the difference of monies is an allowable option.
Frequently asked question number 3. Do I have to pay income tax on the monies I receive in a reverse mortgage?
And the answer is no. And the reason is the monies a senior receives from a reverse mortgage is not considered income because it is a loan. If the government taxed all loan proceeds, nobody would be taking out loans.
Frequently asked question number 4. What is the difference between a reverse mortgage and a bank home equity loan?
And here it is. With a traditional second mortgage or home equity line of credit, a senior would be required to make monthly payments, which might be a financial hardship since most seniors are on a fixed income. The reverse mortgage is different in that it pays monies to the senior. A senior does not have to make monthly payments, plus more importantly, the amount of money available in the senior's line of credit increases each year. Like all homeowners, a senior is still required to pay their property taxes, homeowners insurance, and other conventional payments like utilities. The next part of the show will discuss the major concerns and misconceptions that seniors have concerning reverse mortgages. Let's start off with concern number 1. Do I have to pay income tax on the monies I receive in a reverse mortgage? And the answer is no. Proceeds received from a reverse mortgage are loan advances and are not taxed as income. So the money a senior receives in a reverse mortgage, just to repeat, will not be taxed as income. Let's go to concern number 2. Will the bank own my home? This is the biggest misconception concerning reverse mortgages. The bank does not own a senior's home. The bank does not want the home. A senior and their spouse will always retain title to their home. Much like a traditional mortgage, the home serves as a security against the debt. All a senior needs to do is pay their property taxes, keep their homeowner's insurance current, maintain their home in average condition, and the bank will never take their home with a reverse mortgage. Off to concern number 3. Will this income affect my Social Security or Medicare benefits? And the answer again is no. A reverse mortgage will not affect Social Security and Medicare benefits because these are federal entitlement programs offered to everyone of a certain age. Please know that the needs-based programs such as Supplementary Security Income, SSI, and Medicaid may be affected by reverse mortgage proceeds. Now, on to concern number 4. What about my kids? Will my children or heirs get stuck with repaying a loan balance greater than the value of my home? And the answer is no. Reverse mortgages, as mandated by the Department of Housing and Urban Development, HUD, are non-recourse loans, which basically means a senior can never owe more than what the house can be sold for. Let me give you an example. Let's say when a senior passes away, their estate owes $300,000 on a reverse mortgage, but the house is only worth $250,000. Well, the heirs will sell the house for the $250,000, give the bank the $250,000, and the heirs are not responsible for the $50,000 difference. Remember, a senior could never owe more money than what the house is worth. We're at concern number 5. Can I get a reverse mortgage if I am behind in my mortgage payments or even in foreclosure? And the answer is yes. Many homes owned by seniors that have been behind for over 7 months in their monthly mortgage payments or even foreclosure have been saved with a reverse mortgage. On to concern number 6. What type of homes are eligible for a reverse mortgage? And the answer is the home must be a single family or a 2 to 4 family property that a senior owns and occupies. Townhouses, condominiums, and some manufactured homes are eligible. Condominiums must be FHA approved. For the co-op owners out there, at this time co-ops are not available in a reverse mortgage, but hopefully soon that may change. Concern number 7. What if one of the co-borrowers passes away? And the answer is the surviving borrower can continue to own and live in the home and enjoy all the benefits of a reverse mortgage. And let's put this into regular words. You have a husband and wife on a reverse mortgage. The husband passes away at 120 years old, and the wife passes away at 150 years old. The reverse mortgage is not due until the wife passes away at 150 years old. And the last concern is, I've heard that the closing costs on these reverse mortgages are very high. Is that true? And the answer is, closing costs have come down for higher valued homes and for qualified borrowers. Recently, new programs have been developed to hopefully fit the financial needs of each individual senior.
Frequently asked question number 5. Other than repaying the principal and interest, what kind of fees are involved in a reverse mortgage?
And the answer is, most reverse mortgages have an origination fee, mortgage insurance, title insurance, and other closing costs. These charges can be paid by the reverse mortgage itself, making them not an immediate burden to the senior. The costs are added to the principal and paid at the end with interest when the loan becomes due.
Frequently asked question number 6. Who really owns my home if I get a reverse mortgage?
And the answer is, a senior does. A reverse mortgage is just a lien similar to a traditional mortgage. The senior retains title and can sell their home if they wish at any time. And the next part of the show will review what we have heard so far by stating some fast facts, the benefits, and the reasons why seniors entertain a reverse mortgage. Let's start off with
the fast facts. Fast fact number 1. All borrowers must be 62 years old or older.
Some seniors may have a question that goes like this. I am 62 years old, but my wife is only 59 years old. Can we get a reverse mortgage? And the answer is yes.
Let's go to fast fact number 2. The reverse mortgage loan is not due until either the senior's home is sold, they move out, or pass away. And let me clarify that statement. Many seniors wonder how long their heirs have to pay off the reverse mortgage after they pass away, and the way it works is as follows. The reverse mortgage bank will give 6 months to either sell or refinance the home, and will also provide 3-month extensions above the 6 months if needed. Let's go to fast fact number 3. A senior could never owe more money than what their house is worth.
On to fast fact number 4. When the loan becomes due, the senior's heirs have a choice. They can repay the loan and keep the house, or they can sell the home and repay the loan. Fast fact number 5. Social Security and Medicare benefits are not affected by a reverse mortgage. And lastly, fast fact number 6. A senior owns his home. The bank never takes control of the title.
Let's move to the benefits of a reverse mortgage. Benefit number 1, tax-free income. Benefit number 2, no monthly payments. Benefit number 3, there are no prepayment penalties. Benefit number 4, a senior has the ability to provide for himself and his family a higher quality of life. And lastly, reasons why seniors get a reverse mortgage. Number 1, pay for home repairs or renovations. Number 2, purchase long-term health care. Number 3, pay off their high-interest credit cards. Number 4, pay for their daily expenses. Number 5, pay for their health care and prescription drugs. Number 6, meet unexpected medical expenses. Number 7, pay their property taxes. Number 8, help with their grandchildren's education. Number 9, pay off an existing mortgage. Number 10, make car repairs or buy a new car. And number 11, a senior can do anything they want with the reverse mortgage. It's their money. As we are now moving along, I wish to clarify a very important issue concerning reverse mortgages. As I've stated before in this program, a reverse mortgage requires no monthly payments, and the loan is not due until the home is either sold or all borrowers have passed away. But let's visit the requirements needed to maintain a reverse mortgage. And they are as follows. Number 1, the home that has a reverse mortgage must be the primary residence of the senior. Number 2, if the senior does not maintain the property as a primary residence for a time frame that exceeds 12 months because of a physical or mental illness, the reverse mortgage loan can be due. In regular words, if a senior goes to a nursing home and is there longer than 12 months, the reverse mortgage loan can become due. On to number 3. If the property has a reverse mortgage and is in disrepair and the senior has refused or is unable to fix the property, the reverse mortgage loan can be due. Number 4, a senior must pay their property taxes and homeowner's insurance. These 2 items are so very important. Remember, the reverse mortgage bank can terminate a reverse mortgage loan immediately and require payment of the entire balance if any of these rules are not followed.
Frequently asked question number 7. Who gets my home after I pass away?
And the answer is, your estate does. Your heirs have a choice of keeping or selling the house that has the reverse mortgage. If they decide to sell the home, the proceeds of the sale would be used to repay the mortgage, with the remainder going to the heirs. Remember, a senior could never owe more than the value of their home. None of a senior's other assets will be affected by HUD's reverse mortgage loan. The debt will never be passed along to the estate or heirs.
Frequently asked question number 8. When must a reverse mortgage loan be repaid?
And the answer is, a reverse mortgage loan becomes due and must be paid in full when one or more of the following conditions occurs. Number 1, the last surviving borrower passes away or sells the home. Number 2, all borrowers permanently move out of the home. Number 3, the last surviving borrower fails to live in the home for 12 consecutive months due to a physical or mental illness. On to number 4, a senior fails to pay their property taxes or homeowner's insurance. And lastly, number 5, a senior lets the property deteriorate beyond what is considered reasonable wear and tear and does not correct the problem.
Let's move on to another important topic, which is educating on the different reverse mortgage programs that are available to seniors. There are 2 different types of reverse mortgages in the reverse mortgage universe. There is the fixed rate and there is the adjustable rate. And both interest rates are low at this time. Let's create an example so we can understand the different reverse mortgage programs. Let's say a senior is eligible for $200,000 in a reverse mortgage and wants a fixed rate. Well, the advantage with the fixed rate is that the interest rate is fixed for the life of the loan. It is a locked interest rate that cannot go higher or lower. Now, the disadvantage to the fixed rate, if it's a disadvantage, is that whatever monies a senior is eligible for, he or she has to take the full $200,000 out at closing. So to repeat, if a senior wishes to have a fixed rate, whatever monies they are eligible for in a reverse mortgage must be fully taken out at closing. If a senior is taking most of the monies out at closing to pay off an existing mortgage or paying off credit card debt or taxes that are due, then a fixed rate might be the way to go. But if a senior only wants a smaller portion of what they are eligible for, then a senior may want to consider the adjustable rate. So let's go back to our example where a senior is eligible for $200,000 in reverse mortgage and has no existing mortgage, but needs monies to fix up their home and only would need about $50,000 to make the needed repairs. Well, in this example, the senior can get the adjustable rate program. Now, the disadvantage with the adjustable rate, if it's a disadvantage, is that it adjusts, but the advantage with the adjustable rate is as follows. Let's go back to the chart. As you can see, the senior is eligible for $200,000, but only needs $50,000. Well, in this case, the senior will take out the $50,000 at closing, and yes, interest will start accruing on the $50,000, and the $150,000 balance will be put into a line of credit established under the senior's name. No interest will accrue on that $150,000, and that $150,000 will always be there. And the senior can take monies out of their line of credit at any time they desire. The main reason why seniors would consider the adjustable rate is simple. Why have interest accrue on monies that you do not need at the present time? Another advantage with the adjustable rate is that the line of credit increases in borrowing power, not interest, each month. So a senior with $150,000 in the line of credit could possibly see thousands of dollars of additional funds added to the $150,000 line of credit after a year.
Update on recent changes to reverse mortgages.
In generality,
Many senior homeowners that were approved for a reverse mortgage withdrew the full amount of monies they were eligible for all at once. This in part strained the Mortgage Insurance Premium Fund, known as MIP, that protects seniors in a way that a senior could never owe more money than the value of their home when the loan becomes due. The reverse mortgage banks as well have the opportunity of utilizing the mortgage insurance premium fund in case the amount of monies they are owed on a reverse mortgage loan is higher than the eventual sale amount of the home. The Federal Housing Agency, which insures home mortgages, is struggling with significant losses in its reverse mortgage program, and it's because of these losses that changes in reverse mortgages have come to be. And let's give you a quick example on how the mortgage insurance premium fund works. Let's say a senior passes away and they owe $350,000 on the reverse mortgage, but their home is only worth $300,000. Well, the heirs will sell the house for the $300,000, give the bank the $300,000, and the heirs and the estate are not liable for the $50,000 difference. Now, the reverse mortgage bank is not going to lose out on that $50,000. The bank will utilize the mortgage insurance premium fund to recover their $50,000 shortfall. A win-win for all parties. A senior's estate could never owe more monies than the value of the home, and the bank is guaranteed to get every single dime that is owed to them when the reverse mortgage loan becomes due, either by the sale or the refinancing of the home, and if needed, the utilization of the mortgage insurance premium fund. Remember, the Mortgage Insurance Premium Fund, known as MIP, is a needed entity to ensure that reverse mortgages remain a viable option for seniors for the years to come, and it is the main reason why reverse mortgages have been around for well over 25 years. So let's go back and give you a brief overview of the recent changes to reverse mortgages. Number 1, first year limit. There will be a limit on the amount of money that can be withdrawn in the first year with a reverse mortgage. And here is an example. A senior has no existing mortgage and is eligible for $200,000 in an adjustable rate based upon their age and value of their home. The senior would only be eligible for $120,000, which is 60% of the $200,000 for the first year. After 1 year, a senior will then be able to withdraw the remaining 40%, in which for this example is $80,000. On a side note, seniors will be able to draw more than the 60% limit for the first year with an adjustable rate if their existing mortgage, along with other items like past due property taxes or tax liens, exceed the 60% limit, plus receive the full balance of what they are eligible for after the first year. Please be aware that a senior who desires a fixed rate has the opportunity of receiving less monies compared to the adjustable rate. And here is your example. A senior has no existing mortgage and is eligible for $200,000 in a fixed rate based upon their age and value of their home. The senior would only be eligible for $120,000, which is 60% of the $200,000 for the first year. After 1 year, a senior will not be eligible for the $80,000 difference. If in this example the $120,000 is a sufficient amount of monies that a senior would need, then the fixed rate may be the way to go. But if the $80,000 difference is needed in the future, then the adjustable rate may be the better alternative. There is an exception to the fixed rate option. Seniors will be able to draw more than the 60% limit with a fixed rate if their existing mortgage, along with other items like past due property taxes or tax liens, exceed the 60% limit. So seniors can withdraw enough money to pay off these types of mandatory obligations, plus receive only 10% in cash based upon the maximum allowable amount. Example: a senior has an existing mortgage of $150,000 and is eligible for $200,000 in a fixed rate based upon their age and value of their home. Even though the existing mortgage exceeds the 60% threshold, the reverse mortgage bank will take the $150,000 from the $200,000 and pay off the senior's existing mortgage, plus give the senior 10% of the $200,000, which is $20,000, in tax-free cash. In this example, the senior would be forfeiting $30,000 by choosing the fixed rate. Only seniors who choose the adjustable rate that offers a line of credit may be able to access more money over time and receive the full amount of monies they are eligible for. On to number 2, financial assessment. As I've stated before, a reverse mortgage loan is not due until all borrowers either have passed away, moved out, or sold their home. For a senior to maintain their reverse mortgage, the house must be their primary residence. The house also must be maintained in average condition, and more importantly, seniors are required to pay their property taxes and homeowners insurance. Over the past years, a percentage of seniors with a reverse mortgage have failed to pay their property taxes and their homeowners insurance, and it is because of this failure that financial assessment has come to be. The reverse mortgage bank will be required to ensure that the senior borrower can afford to make all the necessary tax and insurance payments over the projected life of the loan. The reverse mortgage bank will analyze all of the senior's income sources, which includes any earnings as well as pension income, Social Security, individual retirement accounts, and 401ks, among other things. A senior's credit history will also be factored in. The reverse mortgage bank will also look closely at how much money is left over after a senior pays his or her typical living expenses, which includes all property-related costs, federal and state income taxes, utilities, and other debts and obligations like a car payment or alimony. If the reverse mortgage bank determines that a senior is not able to keep up with his or her property taxes and the required homeowners insurance payments due to their shortage of income, a senior will be required to set aside a certain percentage of money that they are eligible for in a reverse mortgage to pay for that shortfall.
Let's discuss the reverse mortgage process if a senior has an interest in getting a reverse mortgage. We start off with process number 1, the education. For a senior, this is the most important stage of the process. A senior is taking the time to learn about the reverse mortgage program in detail and to determine if it is appropriate for themselves and their family. On to process number 2, the application. Once a senior has completed their reverse mortgage education and decides that they wish to get a reverse mortgage, the next step is the loan application. A senior will sit with a reverse mortgage specialist in their home, if they desire, to review all the financial options and programs that are available to that senior, and also make sure the senior understands reverse mortgages from start to finish. Once the senior has completed and signed their application, it is off to process number 3, the counseling. As part of the reverse mortgage application process, all seniors are required to participate in a consumer education session with a housing and urban development approved counselor that can be completed over the telephone. A senior does not have to leave their home for a counseling session. When a senior speaks with the counselor, he or she will explain the legal and financial obligations of the reverse mortgage program, as well as any other alternatives that might benefit the senior. A reverse mortgage is not for everyone, so this step will help ensure the senior that they are making the right decision. After the counseling session has been completed, a senior is given a certificate of HECM counseling, which is valid for 180 days from the session date. Only after a senior has completed the counseling session, signed and dated the certificate, can the next step of the process continue. We're on to process number 4, the appraisal. A professional FHA appraiser will be used to determine the value of a senior's home, in which that value will be used to calculate the exact amount of monies that a senior is able to receive as part of their reverse mortgage. Onward to process number 5, homeowners insurance. Most banks will require that a senior show proof that they have purchased home insurance or hazard insurance, which will protect the senior in case their home is destroyed as a result of fire, theft, or some other disaster. If a senior already has home insurance, they should just verify that their homeowner's policy is up to date, payments are current, and they have the minimum amount of coverage required by the bank. Next, process number 6, mortgage insurance. The reverse mortgage bank will also require a mortgage insurance policy. Now, your homeowner's insurance policy and the mortgage insurance policy are two different entities. The mortgage insurance policy will protect the senior and his or her heirs by ensuring that the amount required for repayment of the reverse mortgage will never exceed the value of the home when payment is due. In simple words, a senior and his or her heirs could never owe more money than what the house is worth. An initial premium will be due upon closing of the reverse mortgage, and this payment can be financed as part of a senior's reverse mortgage proceeds. And lastly, process number 7, the closing. Once the application, counseling, title, appraisal, and all other items concerning the senior's loan application have been completed, then the closing will take place, in which most cases the closing can be done right at the senior's home if they desire.
Frequently asked question number 9. Can I qualify for a reverse mortgage?
And the answer is, to be eligible for a reverse mortgage, a senior must be at least 62 years old or older. The senior must be the owner and on title of the property. The home that the senior is utilizing for a reverse mortgage must be their primary residence, and most importantly, the monies that a senior is eligible for must pay off any existing liens or mortgages.
Frequently asked question number 10. What type of homes are eligible for a reverse mortgage?
And the answer is, the senior's home must be a single-family dwelling or a 2 to 4 unit property that the senior owns and occupies. Townhouses, detached homes, FHA-approved condominiums, and some manufactured homes are eligible. The home must be in reasonable condition and must meet HUD property standards. For the co-op owners, a reverse mortgage is not available at this time.
All righty then. Let's move along and summarize what the loan specifics are with the reverse mortgage. Specific number 1, eligibility requirements. The eligibility requirements for a reverse mortgage are quite simple. All seniors must be age 62 or older and occupy the property as their primary residence. Their home must have a remaining mortgage balance which can be paid off by a reverse mortgage. If not, a senior has the option of coming up with the difference out of their own pocket. The property must be a single family or a 2 to 4 unit dwelling. Townhouses, detached homes, condominium units, planned unit developments, PUDs, and some manufactured homes are eligible. The homes must meet HUD minimum property standards. In some cases, home repairs can be made after closing of a reverse mortgage. On to specific number 2. How much can be borrowed? The maximum amount that a senior can borrow with a reverse mortgage is based on the following factors: the age of the youngest borrower, the appraised value of the home, the current interest rate. In general, the more a senior's house is worth, the older they are, and the lower the interest rate, the more a senior will be able to borrow. On to specific number 3, the payment options. Each senior has their own unique money needs. For some seniors, taking the entire amount of monies that they are eligible for up front is an option, while others would prefer a steady monthly payment to supplement their other income. Or a senior can take only the monies that they are in need of at the time and put the balance of their monies into a line of credit that is established under their name. Please note, the payment plan a senior picks most likely will depend on their existing mortgage balance. Moving on to specific number 4, the interest rate. A reverse mortgage loan will be made based on either a fixed rate or an adjustable rate loan. Rates are linked to the LIBOR, which stands for London Interbank Offering Rate. A change in the interest rate has no effect on the amount of or number of loan advances a senior can receive. On to specific number 5, loan repayment. A reverse mortgage loan is due and payable when a senior no longer occupies the property as their primary residence, passes away, sells the home, or the home is in disrepair, or the senior fails to maintain their property taxes and homeowners insurance payments. For repayment of a reverse mortgage, there is no requirement that the property be sold, only that the loan be repaid. This may occur either through the sale of the senior's home or through other resources such as savings or possibly applying for a new mortgage. And lastly, specific number 6, the effect on public benefits. A reverse mortgage will not affect Social Security and Medicare benefits because these are federal entitlement programs offered to everyone of a certain age. Please know that the needs-based programs such as Supplementary Security Income, known as SSI, and Medicaid may be affected by reverse mortgage proceeds. Okay, we're moving towards the end of the show, and at this point, let's go over the upsides and the downsides of reverse mortgages. And let's start off with the upsides first. Upside number 1, a senior can choose how to receive their money in a reverse mortgage. They can either choose a lump sum, line of credit, or some combination of these two options. Upside number 2, monies received from a reverse mortgage will not affect a senior's Social Security or Medicare benefits. Upside number 3, if a senior outlives the loan, meaning a senior receives more in payments than what their house is worth. A senior or the heirs will never owe more money than the value of their home. On to upside number 4. Monies received in a reverse mortgage is tax-free income. Upside number 5, a senior retains title to their home. Upside number 6, no payments are due until the last surviving borrower dies, or the senior sells their home, or the senior no longer lives in the home as their primary residence. Upside number 7, a senior can remain independent and stay in their home. Upside number 8, a senior does not have to make any monthly payments at all with a reverse mortgage, but if a senior wishes to make a payment at any time, they can. There is no prepayment penalty. And lastly, the main upside with the reverse mortgage is that a senior can pay off their existing mortgage or get out of foreclosure or pay off their high credit card debt, and now a senior will not have to make any more monthly payments to the previous mortgage bank or make any more payments towards their credit card bills. Let's move on to the downsides of a reverse mortgage. And here it is, downside number 1. Reverse mortgage proceeds could impact Supplementary Security Income, known as SSI, and Medicaid eligibility. Downside number 2, seniors must be at least 62 years old to qualify. Downside number 3, certain reverse mortgage programs have high closing costs. On to downside number 4. The reverse mortgage debt increases over time as interest is charged to outstanding balance of the loan. Downside number 5. As a senior's home equity is used up, fewer assets are available to leave to their heirs. And downside number 6. Interest is not tax deductible until the loan is paid off. And lastly, downside number 7. A senior is responsible for paying their property taxes and homeowners insurance. And if they don't, the loan can become due.
Frequently asked question number 11. How much money can I receive in a reverse mortgage?
And the answer is, the amount of monies available to a senior is based upon several factors. The age of the youngest borrower, the home value, the current interest rates, and the type of reverse mortgage program a senior chooses. In general, the higher the age of the senior, the higher the value of the home, the more money is available to the senior.
I hope you have learned much today, and I wish to end the show with a question for you. Did you know that a senior who is 62 years old or older can purchase, that's what I said, purchase a new home with a reverse mortgage? Well, a senior can. The Reverse Mortgage for Home Purchase program is designed to allow seniors to purchase a new home and never have to make monthly mortgage payments for as long as they live in the home. There are many seniors who are not comfortable with their present home as it no longer suits their needs and the kids have moved out and the house is just too big to maintain. The Reverse Mortgage Home Purchase Program was designed to enable senior homeowners to relocate to other geographical areas so they could be closer to their family members or just downsize, as I stated before, to homes that meet their physical needs, whether it be handrails, one-level properties, ramps, or wider doorways, and the list goes on. It all depends upon the senior's needs. Now, please be aware that a senior will need to have their own monies available as part of a down payment on the home they wish to buy with a reverse mortgage. And let me give you an example. Let's say a senior, 69 years old, wants to purchase a new home that has a value of $300,000. And the senior has $250,000 in cash from the sale of their prior home, but does not want a mortgage since it will be a burden each month coming up with the monthly payment. Also, the senior does not want to put all of the $250,000 down on a new home purchase since it will deplete the senior of all their monies. And the solution is, in the above example, the 69-year-old senior can take a reverse mortgage for home purchase, be eligible for about $135,000 towards the purchase price of the $300,000, and only have to come up with the difference of $165,000 at closing. The benefit is, the senior makes no monthly payments on the $135,000, although a senior can make payments at any time for any dollar amount because there is no prepayment penalty. The principal and interest are only due when the senior passes away or sells the home. Also, more importantly in this example, the senior is left with $85,000 out of $250,000 and has monies available hopefully for years to come. So, I hope this show has been helpful in your education of this very unique and needed product for seniors. And as I stated in the beginning of the show, I believe it is imperative that all seniors be aware of the financial options that are available, and the option of a reverse mortgage may be the best option available. Good day, everyone.